Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session. In today's session, we are going to discuss a very important report that is recently released by the Reserve Bank of India. And why this report is very important, because in the past year, there has been a question directly from this report in the RBI Grade B examination. Okay, so this report is very important from the RBI examination perspective. So let's get started. First of all, am I clearly audible and visible? Give me a thumbs up. Good morning everyone and welcome to the session. Give me a thumbs up if I am clearly audible and visible, and if there is no problem in the audio and visuals. Okay, so today we are going to discuss about the half yearly report that is released by the Reserve Bank of India recently in the May month, and this report is in regards to the management of the foreign exchange reserves. And from this report, a question has come in the previous year RBI Grade B examination. Okay, so RBI has boosted its gold reserves over 6 months. So let's discuss about the gold reserves and the other foreign exchange reserves of the Reserve Bank of India. Okay, so let's start with the session, but before that, do subscribe to the YouTube channel of EduTap and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel, it is provided in the description box below. Okay, so first of all, let's start with the 44th half yearly report on the management of foreign exchange reserves. So this is the half yearly report and this is released for the month of October 2024 to March 2025. So for this period, for this half year, the management of foreign exchange reserves half yearly report is released, and this is released in May 2025. Okay. So this is the half yearly report that is released by the Reserve Bank of India. Now the Reserve Bank of India has released the 44th half yearly report on the management of foreign exchange reserves for this time period that is ending March 2025. Now, in February 2004, the Reserve Bank had started a process of compiling the half-yearly reports to make it more transparent that how the Reserve Bank of India manages the foreign exchange reserves. Okay, so to make it more transparent, to make it available in the public domain, that how the foreign exchange reserves are maintained by the Reserve Bank of India, the RBI decided to compile the half-yearly reports on the regular basis. Okay. Now, the Reserve Bank of India publishes half-yearly reports on management of foreign exchange reserves on the regular basis, and this is released for end March and end September each year. So, for the end March 2025, the report is released in May 2025. Okay. So, for the end March 2025, the report is released in May 5, 2025. Now, you can understand that the next report for the end September 2025, the next report for the end September 2025, now this will be released around November, December. Okay, so at that time, during that time, your examination would have been finished. Okay, so this report is important because the next report will be released after your examination, we can say. So this report becomes more important. Now, during the half year period under the review that we are discussing from October 2024 to March 2025, there was a decrease from USD. There was a decrease from US dollar 705.78 billion of foreign exchange reserves. So foreign exchange reserves decreased during the half year that we are discussing. The foreign exchange reserves actually decreased from $705 billion from in September 2024 to US dollar 630 billion as at end January 2025. So you can understand that from September 2024 to January 2025, there was a decrease that happened in the foreign exchange reserves. Now this decrease was because of the balance of payment situation that we are going to discuss, as well as because the depreciation of rupees was happening. Because the depreciation of rupee was happening, the rupee was weakening against the dollars. That means rupee's value was decreasing against the dollars. So due to this situation, the RBI also had to release the dollars. RBI also had to supply the dollars so that the rupee depreciation can be reduced. So RBI supplied the dollars. Okay, because if RBI supplies more dollars, the dollar value starts decreasing against the rupees and the rupee value starts increasing to an extent. So the depreciation could be stopped of rupees, or depreciation could be reduced if there is supply of dollars that is done by the Reserve Bank of India. Okay, so RBI also supplied the dollars to reduce the depreciation of rupees, as well as due to balance of payment situation also there was less dollars that we achieved. Okay, so there was the reduction in the foreign exchange reserves because of two things: because of the balance of payment situation that we are going to discuss in the coming slides, as well as because the RBI was supplying the dollars, was selling the dollars to reduce the depreciation of rupees. So due to these two things, the foreign exchange reserves started to decrease. Okay. Now, at the if we see at the end of March 2025, there was a slight increase that has been seen in the foreign exchange reserves, and by the end of March 2025, the foreign exchange reserves increased to $668.33 billion. So this is the idea that from September 2024 to March 2025, there is a decrease that has been seen from $705 billion to $668 billion. Okay. Now the next point here you can see that from September 2024, in September 2024, we had very high reserves. The foreign exchange reserves were very high. We were even higher than $700 billion. We achieved more than $700 billion of the foreign exchange reserves. But after that, the foreign exchange reserves kept on declining till January 2025. And after that, there is a slight increase that we have seen in the foreign exchange reserves. And in March 2025, the foreign exchange reserves were around $668 billion. Got it? Any confusion here? All clear? I will take all the extra queries at the end of the session. If you have any query regarding this PPT or regarding the topic that I am discussing, that you can ask right now. All the extra queries I will take at the end of the session. Now I have told you that the foreign exchange reserves decreased because of two reasons. First, the RBI was supplying the dollars, so RBI was selling the dollars, so foreign exchange reserves will reduce, as well as foreign exchange reserves also reduced because of the balance of payment situation. Now, what was the balance of payment situation? In the balance of payment, there are two accounts. Anyone know that what are the two accounts in the balance of payment? What are the two major accounts of the balance of payment? Tell me that. The current account and the capital account, right? What are the components of current account? What are the major components of current account? There are three components of current account: trade in goods, trade in services, and transfer payments, right? In the capital account, there are again three components. In the capital account, there is investment, there is external borrowings, and there is external assistance. Okay, so these are the three components in current account. These are the three components in capital account. Okay, now in the current account, trade in goods, trade in services, and transfer payment. Let's say trade in services. If we are talking about the balance of payment, we are talking about the receipts of our country minus the expenditure that we are doing. Okay, so how much we are receiving from other countries minus how much we are spending in the other countries. Okay, so in trade in goods, how much we are receiving for our exports that we are doing, how much dollars, how much foreign currency we are receiving for the exports we are doing, minus how much we are paying, how much we are spending for the imports that we are doing. Similarly, in the services also, how much we are receiving for the services that we are providing minus how much we are paying for the services that we are getting. In the transfer payment, how much remittances, how much gifts we are getting minus how much gifts or remittances that we are giving. In investment, how much we are getting in investment, in foreign direct investment, foreign portfolio investment, minus how much we are doing the investment in other countries. So in balance of payment, always we see that how much we are receiving in a particular component minus how much we are spending in a particular component. Let's say now, let's say that the trade in services and the the transfer payments, they are in the surplus of $10 billion and $20 billion. But the trade in goods is in the deficit of $50 billion. So can you tell me that the current account, is it going to be in surplus or deficit? Tell me very fast that if the trade in goods is in the deficit of $50 billion while the trade in services is in the surplus, that means we are getting more than we are spending. So it is in surplus of $10 billion. Transfer payments, remittances and gifts are in surplus of $20 billion. So basically, in the current account, these are the three components. So are we in surplus or deficit? Or if we are in surplus, what is the surplus amount? If we are in deficit, what is the deficit amount? We are in deficit. Okay, very good. First of all, current account is in deficit. How much is the deficit? Can you tell me? How much is the deficit? How much is the deficit? So the surplus is in the current account, the surplus is of $30 billion, but the deficit is of $50 billion in the trade in goods. So that means in total there is deficit of $20 billion, correct? Right? So there is the deficit of $20 billion because the surplus is of $30 billion while the deficit is of $50 billion. So in total there is a deficit in the current account. In totality there is a deficit of $20 billion, right? Very good. Now just see these data points. This was the example that I have given you. Okay, so I hope you have understood about the balance of payment and you enjoyed this session. Like it was static, but I hope you enjoyed the static understanding. Okay, now the current account balance, we are comparing the data of April to December 2023 to April to December 2024. Now asterisk is shown because this is the available data that is present and this is the verified data that is present only. Okay, so we are comparing the April to December 2023 with April to December 2024. The current account balance, the current account, trade in goods, trade in services, transfer payments. So these are the three components in current account. So it was in deficit and you can understand that the deficit has increased from $30.7 billion. So this is in USD billion. Okay. So the deficit has increased from $30.7 billion to $37.1 billion. So the deficit has increased. Now, in the capital account, you can understand in the capital account, there is investment, external borrowings, external assistance. So in the capital account, the surplus was there of $63.6 billion that has reduced in the 2024 to $23.3 billion. So now try to understand that in the current account, there is the deficit of $37.1 billion. And in the capital account, there is the surplus of $23.3 billion. So balance of payment will be in surplus or deficit. The current account is in the deficit. The capital account is in the surplus. But the current account deficit is around $37 billion. The capital account surplus is $23 billion. So in total, the balance of payment is in surplus or deficit. Is in surplus or deficit. So it will be in deficit, right? It will be in deficit of 13.7 to $8 billion. So this is the idea that there is the deficit of $13.8 billion in the balance of payment, right? So on a balance of payment basis, that is excluding valuation effect. For now, exclude this valuation effect. Do not focus on it. I will explain you that what is this valuation effect. But first, let's understand the balance of payment. Okay. On a balance of payment basis, excluding the valuation effect, the foreign exchange reserves decreased by US dollars $13.8 billion. So foreign exchange reserves. Now balance of payment was in deficit of $13.8 billion. So foreign exchange reserves had to be used. The balance of payment was in deficit of $13.8 billion because there was a huge deficit in the current account, right? And we have to cover the current account deficit. It's not like that we have taken the imports and now we are saying we cannot pay, we will not pay. That we cannot do, right? We have to pay if there is the deficit or if there is the like payment that we have to make, we will have to make it. So we will use the foreign exchange reserves for it. So 13.8 of the foreign exchange reserves will be used. So actually on a balance of payment basis, the foreign exchange reserves decreased by US dollars $13.8 billion because we had to cover the deficit during the April-December 2024. So this is the data for April to December 2024. Compared to the accretion of US dollars in the previous year, actually the foreign exchange reserves increased by $32.9 billion during the April-December 2023 because in the previous year the capital account surplus was way high and that's why in total in the previous year there was the surplus and the foreign exchange reserves increased, but in this year there is a deficit that is higher and that's why the foreign exchange reserves decreased. Okay, understanding the point? Now let's understand the valuation change. Till now any confusion anyone has? Till now any confusion anyone has? Give me a thumbs up if everything is clear. Clear, right? No confusion? Okay. So now, See, the valuation change. What is the valuation change first of all? Now we will understand this point. See, in the balance of payment, in the foreign exchange reserves, how many of you know that gold is a part of foreign exchange reserves? In the foreign exchange reserves, the RBI also keeps the gold. So gold is also a part of foreign exchange reserves. Now the gold, let's say you have bought 10 kgs of gold. So today you have bought it for, let's say 20 lakhs. Now by tomorrow, its gold valuation increases. Maybe its value will increase to 21 lakh. By the next year, the value will increase to 30 lakhs, let's say. So this is the idea that when the gold is a part of foreign exchange reserves and the RBI keeps the foreign exchange reserves in gold. Now the gold value increases. So there is a valuation change in the foreign exchange reserves that happens because of the increase in the value of gold. So in the 2023 April to December time period, the gold value increased by $11.1 billion. While in the April to December time period of 2024, the gold value increased by $3.1 billion. So that means the gold value further increased. And because of this increase in the gold value, the foreign exchange reserves that reduced. So you know that because of this deficit, the foreign exchange reserves, because of the deficit in the balance of payment, the foreign exchange reserves reduced by $13.8 billion. But because the gold value increased, in the time period of April to December 2024 by $3.1 billion, so the gold value increased by this. So actual foreign exchange reserves that decreased. So because of the balance of payment, situation, the foreign exchange reserves decreased by $13.8 billion. But because the gold value has increased in the foreign exchange reserves, so taking that into account, the actual decrease in the foreign exchange reserves is of $10.7 billion. So this is the idea that foreign exchange reserves in nominal terms, including the valuation effect, that is the primarily reflecting higher prices of gold. So if we take into account the higher prices of gold, the decrease in the foreign exchange reserves will be $10.7 billion rather than $13.8 billion. Got it? So this is the whole idea, that this is the part of the foreign exchange reserves. It reduced as we have seen. The foreign exchange reserves reduced from September 2024 to January 2025 because of the balance of payment situation, as well as because of the supply of dollars that RBI had to do. Okay. So this is clear, right? Let's move forward now. Now in the foreign exchange reserves, what are the parts of the foreign exchange reserves? Okay. So in the foreign exchange reserves, there are the foreign currency asset. In the foreign exchange reserves, what does RBI hold in the foreign exchange reserves? So in the foreign exchange reserves, first of all, this is under the Reserve Bank of India. The RBI has to keep the foreign exchange reserves, right? The RBI keeps the foreign exchange reserves. Now in the foreign exchange reserves, RBI keep the foreign currency asset. In the foreign currency asset, there is US dollar, there is euro that RBI is keeping, there is some Japanese yen that RBI is keeping, pound sterling that RBI is keeping. So FCA, that is foreign currency asset, this forms the biggest chunk of the foreign exchange reserves. Okay. Yes, in valuation change, mostly the gold value is kept. Okay, we can see the other values also, that maybe foreign currency asset value has increased, the dollars value has increased or such. But here it is written now. It was written here that valuation gain primarily reflecting higher prices of gold. So primary focus was given to gold. Okay. So now in the foreign exchange reserves, the foreign currency asset, you can see, forms the biggest chunk. So by April 25th, 2025, this was the foreign exchange reserves that RBI held. That was $688.13 billion. And out of that, $580.66 billion. This data you don't have to remember because this will be updated in next month also in the monetary policy statement and after that also. Okay. Just I will give you the idea that what is the foreign currency asset, what is the spatial drawing right and such, that you have to keep in mind. Okay. So you can understand that the biggest chunk in the foreign exchange reserves is of foreign currency asset, and foreign currency asset, they are maintained in a multi-currency portfolio comprising major currencies such as US dollars, euro, pound sterling, Japanese yen and such. Then after that, the RBI also hold gold Gold is also held in the foreign exchange reserves because it is considered stable. Okay. Then the RBI also hold special drawing rights in the foreign exchange reserves. Now, what are special drawing rights? First of all, special drawing right, this was formed by the IMF in 1969. Now, the special drawing right, it is not a currency. It is not a claim, but it is a potential claim on the IMF. Now, the special drawing right, how the value is derived of this special drawing right. The IMF decides the value, or how the value is decided, that what is the value of a special drawing right. So, the value of the special drawing right depends on the value of 5 currencies. That is US dollar, pound sterling, the euro, Japanese yen, and Chinese yuan or renminbi, whatever it is called. Okay, so these are the 5 currencies on the basis of which the value of SDR is determined. Okay, so SDR is an international reserve asset. It is not a currency, it is not a claim, it is a potential claim. It is an international reserve asset that the monetary authorities around the world keep in the foreign exchange reserves. So SDR is an international reserve asset created by the IMF in 1969 to supplement the official reserves of its member countries. Okay, the SDR is not a currency, it is a potential claim on the freely usable currencies. That means if you have the SDR, let's say India has the SDR worth $18.59 billion. So this SDRs can be used to get any of these currencies. Okay, so this is the idea. Now, as such, SDRs can provide a country with liquidity, and if, let's say, RBI do not have the dollars, required dollars, so SDRs can be traded for dollars. If RBI wants yen, the SDRs can be traded for yen. This is the idea. Now, a basket of currencies defines the SDR: US dollar, euro, Chinese yuan, Japanese yen, and British pound sterling. Okay, so this is the idea. Now, how the SDRs are allocated to the member countries? So SDRs are allocated to the member countries on the basis of the quota. Let's say IMF has different members. Now, different members, on the basis of their size of the economy, the different members provide quota to the IMF. Okay, quota subscription. Like, let's say you are joining a golf course, you are joining a club, so you have to provide some membership fee. Similarly, if a country is joining the IMF, if a country is becoming the member of IMF, they have to provide quota to the IMF on the basis of their economy size, on the basis of the size of their economy. Now, on the basis how much a country has provided quota to the IMF allocates certain SDRs to the member country. So, all the member countries, on the basis of their size of the economy, all the member countries have to provide quota to the IMF. Now, IMF on the basis of how much quota the IMF has received from a particular member country, the IMF provides SDRs to that member country. Got it? This is the idea. Now, coming to the next, that is reserve tranche position. Now, whenever a country provides quota to the IMF, whenever a country is providing the quota to the IMF, the part of the quota is provided in the form of hard currencies. Hard currencies are the currencies like dollar, pound sterling, Japanese yen, Chinese yuan, and euro. That are the strong currencies. That are the currencies that are kept in the reserves, or these are the currencies that are used for the transactions at the global or international level. Okay, so quotas are usually, whenever a member country is providing the quota, part of the quota is provided in the hard currencies and the other part of the quota is provided in the domestic currency. Okay, so if India is providing quota to the IMF, India will provide part of the quota in the hard currencies and the rest of the quota will be provided in rupees in the domestic currency. So what is this reserve tranche position? Reserve tranche position, this is equal to the members' quota. Let's say India has provided 100 as the quota. Out of 100, 50 or 70 dollars is provided, or let's say $30 is provided, and 70 rupees is provided. Part of the quota is provided in hard currencies and part of quota is provided in the domestic currency. Okay, so reserve tranche position is equal to the members' quota less the IMF's holding of the members' currency in the general reserve asset. So that means out of the total quota that India has provided, deduct the Indian currency and the rest, that is the $30 that India has provided. That is the reserve tranche position that India can use whenever India wants. Okay, so basically out of the quota that India is providing to IMF, the quota that is provided in the hard currencies, the quota that India is providing in the hard currencies, in the foreign currencies, so part of this hard currencies kept in the reserve transfer position that India can use whenever India wants. So this is the reserve transfer position, that if India is providing, basically India or any other member country is providing the quota to the IMF. Now a part of this quota is provided in the hard currencies and the other part of the quota is provided in the domestic currency. So the part of the quota that is provided in the hard currencies like the dollars or euro or the pound sterling and such, so a part of this is kept in the reserve transfer position that India can use whenever there is any problem that comes in India. So a part of quota that is provided in the hard currency, this can be used by India when India is in problem in the form of reserve transfer position. Any confusion here? So SDRs, I hope you have understood reserve transfer position. I hope this is clear. Yes, quota here means that let's say you have a membership fee. So IMF has a quota that all the member countries have to provide quota to the IMF. Okay. So this is clear. Moving forward, IIP. So India's international investment position, which is a summary. So IIP is what? It is India's international investment position, which includes the India's asset at the global level and the India's liabilities at the global level. Okay. So I hope you know that India's asset at the global level is the investment that India has done on the bonds, shares, the subsidiaries or the branches that India has at the global level. The liabilities of India at the global level will be the loans that India has taken or the entities of India has taken from the international level. Okay. So assets are something that we own and the liabilities is something that we have to return. Okay. So this is the asset and liability. So if we see India's international position, there is a stock. This is a summary record of the stock of countries' external financial assets and the liabilities. This is the financial assets and the liabilities, the summary that is kept in the form of India's international investment position. So India's international investment position at the end of December 2024 that we will see. So during the period between end December 2023 to end December 2024, the external assets increased by $79.7 billion. So the assets, the financial assets has increased by $79.7 billion and the external liabilities have increased by $76.1 billion. So that means the assets have increased more as compared to the liabilities. So assets have increased more than the liabilities. Both have increased, but assets have increased by more. But if you see the totality, this is only for 1 year. If you see the totality that till 2023 or till 2024, what is the total external assets? So total external assets till the end December 2023 were 999 and the total external liabilities till the end December 2023 were 1367. So the liabilities were more and that's why India has a net international investment position of a negative 368. But if we see end December 2024, where the assets increased by more than the liability, but still the liabilities are higher. So here you can see that total external assets increased to $1,078.7 billion, while the total external liabilities increased to $1,443 billion. And the net IIP, this has improved. We can say that the net investment, India's international investment position has improved. That means the liability has decreased to an extent. So the sum of all the external liabilities is more than the sum of all the external assets in both the periods of 2023 and 2024. So the external liabilities basically are more than the external asset. You don't have to remember the numbers because this will be very difficult for you to remember. But remember that if in the descriptive question you can use this data that India's international investment position, or in the objective question if the question comes that what is the situation. So the sum of all the external liabilities is more than the external assets. But there has been a decrease in the negative gap on a year-on-year basis. The negative gap has decreased. That means the liabilities that increased lesser than the increase in asset. Okay. So just the final data you can remember. Just this data you can remember. That the net IIP position. What is the net IIP position? Okay. Next is at the end of how SDR are traded. Basically, spatial drawing, right? Let's say you are going to XYZ company, let's say ABC country, is going to XYZ company. So XYZ company will get the SDRs and will give the dollars, or let's say you want euro, so will give the euro. So the countries, the member countries can trade among themselves. Okay. Now coming to the next point. So at the end of December 2024, the foreign exchange reserves cover of imports stood at 10.5 months. So this kind of data also came in the like this kind of question also came in RBI Grade B 2024 examination. Okay, that how many months of cover does the foreign exchange reserves provide? So foreign exchange reserves provide the cover of imports for 10.5 months, though it was 11.8 months at the end of September 2024, but currently there is a decrease in the foreign exchange reserves that we have seen. Due to this, the foreign exchange reserves provide a cover of imports for 10.5 months. That is still very high. Now the ratio of short-term debt. Short-term debt is the debt of the maturity of less than 1 year, we can say. Okay. So short-term debt to total reserves. Okay. So short-term debt to total reserves ratio has increased from 19.1% to 22%, and this is considered a bad kind of situation, because if short-term debts are increasing, short-term debt are usually taken for the operational purposes, while the long-term debt is taken for the investment purposes. So if short-term debt is increasing in India, that means for the operational reasons the debt is being taken for your day-to-day operations. So this short-term debt is not considered good as compared to long-term debt. So usually the long-term debt is considered better. Okay, but we can see that the short-term debt percentage has increased again as compared to total reserves. Okay, so short-term debt to reserves ratio has increased. The ratio of volatile capital flows. Volatile capital flows means the foreign portfolio investment, as well as the short-term debt, because they are for the they are short-term debts are for the short period of time, and foreign portfolio investment like the investment in bonds, shares, this can be reversed pretty easily. Okay, so volatile capital flows, that is the cumulative portfolio inflows, and the outstanding short-term debt to reserves ratio has increased from 67.8% to 74.3% in the December 2024. So you can understand that the short-term debt to reserve ratio has increased. This is considered a little bad, as well as the volatile capital flows has increased. Volatile capital flows to reserve ratio has also increased because of the portfolio inflows and the short-term debt situation. Next is at the end of March 2025, the Reserve Bank held 879.59 metric tons of gold, of which 511.99 metric tons of gold was held domestically. Okay, while 348.64 metric tons of gold were kept in safe custody with the Bank of England and the Bank of International Settlement. Now from this line also a question has come in the previous year RBI Grade B examination. If you have given the examination or if you have seen the PYQs, you know that directly it was asked that where the gold deposits are being held. So multiple options were given. The right answer was Bank of England and the Bank for International Settlement. So this, from this line direct a question has come. Okay, so that's why I am telling you that this report is important, because one or two questions have been seen from this report. So see, either the RBI is keeping the gold reserves domestically, or a part of the gold reserves are being held in the Bank of England and Bank of International Settlements. Okay, so the 348.62 metric tons of gold were kept in safe custody with the Bank of England and the Bank of International Settlement. 18.98 metric tons were held in the form of gold deposits, as well as in value terms the share of gold in the total foreign exchange reserves. So the share of gold in the total foreign exchange reserves has increased from 9.32% to 11.70%. That means the gold in the foreign exchange reserves, the gold as a part of foreign exchange reserves, it has increased as a percentage. Okay, so this is the idea. Now moving forward, just one or two slides are left. Okay, so as at the end of March 2025, out of the total foreign currency asset, here we are particularly talking about the foreign currency asset. Now what does the foreign currency asset consist of? Can you tell me? What is kept in the foreign currency asset? Gold, SDRs, RTP. What is kept in the foreign currency asset? So foreign currency asset consists of the multi-currency, right? Like the dollars, like the dollars, euro, pound sterling and such, okay. Why they store gold? Why do we keep gold in our homes? Like I also keep some gold because that is considered a mark of safety, and the gold value increases, or it is a stable kind of reserve we can consider. Like I think that most of the Indian households, they keep some gold with themselves because that is the most stable thing that we consider, okay. Okay, so as at the end of March 2025, out of total FCA, out of total foreign currency asset, we are talking about end March 2025, remember. So out of the total foreign currency asset of USD 567.56 billion, USD 485. Now, what do you think? That RBI is holding more than $500 billion in its reserves. Is it not like, should RBI not deposit it somewhere? Should RBI not earn interest on it? If you have, let's say, if you have 10 crore rupees, would you keep it in your vault? Would you not want to do some fixed deposit of this amount? Or would you not want to invest it somewhere to earn more money on this 10 crores? I think that you, rather than keeping it in vault, you would rather do a fixed deposit, or you would rather invest that money. Similarly, Reserve Bank of India, instead of keeping the foreign currency asset with itself, RBI actually invest that foreign currency asset in the securities, or RBI deposit the foreign currency asset with the other central banks and the Bank of International Settlement to earn the interest, as well as RBI deposit the money with the commercial bank overseas, okay. So this is the basic idea, that a part of the foreign currency asset is invested in securities, a part is deposited with the other commercial banks, other central banks and the Bank of International Settlement, and a part is kept with the commercial banks overseas, okay. So the common sense is that rather than keeping it in your vaults, keep it in the banks, or invest it somewhere. So that is what RBI do, okay. Now moving forward, the RBI actually also uses the external asset managers. So a small portion of the reserves is being managed by the external asset managers. So that is invested at multiple places, okay. So this is the idea. Now coming to the last slide, you don't have to go through each and every statement, but I will give you the idea that what is the what is the NAV, what is the FTP, okay, just the basic idea, because these terms were mentioned, so a question can come from these, okay. One more thing, that instead of remember the numbers, the questions from this report has mostly come from that where the RBI deposits, where the RBI invests, where the RBI is putting the money. These are the kind of questions that come. So from this slide, the question can come that which are the following which are the following options in which RBI actually invests the foreign currency asset, okay. So this is the idea. Now coming to the next slide, this is the last one. So during the half year under review, that is from October 2024 to March 2025, there was one purchase transaction. See, under the financial transaction plan of the IMF, this is a kind of borrowing plan of the IMF, or this is a kind of return plan of the IMF. So under the financial transaction plan of the IMF, I'm telling you in brief that the IMF allows the purchase. Purchase means that a country, so if a country is doing the purchase, let's say India is doing a purchase, that means India is taking a loan. If India is doing the repurchase, or India is doing the, repurchase transaction, that means India is returning the loan kind of situation, okay. So there was one purchase transaction aggregating USD $284.86 million. So this much India had taken. Okay, so this was the purchase transaction. This much India had taken from the IMF. 4 repurchase transactions aggregating USD 158.36 billion under the FTP of IMF. So this much was repurchased, or this much was returned. This much was returned. So this is the financial transaction plan through which the through which the IMF let the countries purchase some money, and it lets the country return the money also, okay, through this plan. So government, or India, we can say, it did a purchase transaction of this much amount, and it did 4 repurchase transaction of this much amount, okay. Next is NAB, new arrangement to borrow. Now, how many of you know that IMF lent to various countries? The International Monetary Fund, it lends to its member countries. It provides money to its member countries, right? How the IMF gets the money? How the IMF gets the money to lend to the member countries? So IMF gets the money through the quota subscription, through the quota, or we can say membership fees. So the member countries are providing quota to the IMF. So this is the membership fee to the IMF. But IMF has said that in case there is some emergency and the IMF has used all the quota, all the membership fees, then what will happen? So in this case, if the IMF requires more money, then the IMF can use the new arrangement to borrow, in which IMF will borrow from the member countries. So this is the idea of the new arrangement to borrow. This is the borrowing arrangement for the IMF, that if the IMF requires more funds, the IMF can take the more funds. The IMF can take the more funds through the borrowing arrangement. So if if IMF require more funds, the IMF can take more funds through the new arrangement to borrow. So in this new arrangement to borrow, India's commitment under the IMF's new arrangement to borrow was last raised to SDR 8,881 million SDRs. Okay, that means if the IMF requires the money, the India will have to give SDR 8,881 million SDRs. Okay, this was last raised in January 1, 2021. Now RBI has nil subscription under the NAB. Nil subscription means that till now the IMF has not taken any of the NAB from India. Because new arrangement to borrow will only be required by the IMF if IMF has already utilized all the quota that IMF has got. Okay. So let's say your parents gave you pocket money of 10,000 rupees. If you use all this money, then you can take some borrowings, let's say of rupees 5,000. Okay, from your grandmother. Now grandmother is India here. Okay, so you have not utilized this. You have only used, let's say, 2,000 till now. You still have a lot of pocket money left, so you will not require the borrowing, right? Similarly, IMF has also not used the quota completely, and that's why it was not required that NAB is initiated or the new arrangement to borrow is initiated. So RBI till now has nil subscription under the NAB because it was not required. Okay. Next is shark swap arrangement. So recently it was in news. We have discussed this in a previous session. Okay. So shark swap arrangement, in this is initiated by India. Okay. So shark country, South Asian Association for Regional Cooperation. So in which Pakistan, Bangladesh, like there are various members of the shark nation, that is South Asian Association for Regional Cooperation. In this, India had launched a swap arrangement, in which India said that let's say a country is in a trouble, the shark member is in a trouble, and they, let's say, they do not have the dollars to pay for their imports, or they do not have the foreign currency to pay for the imports. So under the swap arrangement, let's say Malaysia or Maldives, let's say Maldives is giving its local currency to India for a time period, and India will give dollars or the foreign currency to Maldives. And after a time period, after the time period has completed, the Maldives will return the dollars or the foreign currency to India. India will return the money to the Maldives, and India will take some extra amount. Okay. So this is the idea. So under the revised framework on currency swap arrangement for shark countries for the period 2024-27, RBI has signed bilateral currency swap agreements with the Royal Monetary Authority of Bhutan and the Maldives Monetary Authority, because both these countries require the foreign currency. So under the shark swap arrangement, the Bhutan gave its local currency to India for a time period, and India provided the foreign currency or the dollars to Bhutan for its imports and the other things. And after the time period finishes, after the maturity happens, the India will return the local currency of Bhutan, and the Bhutan will give the dollars or the foreign currency back with some extra amount, with some interest, we can say, to India, because India has provided the money, na? So the Bhutan has to provide some interest also. So this is the idea of the swap arrangement. So till now, who has taken the swap arrangement? Bhutan and Maldives. This is what you have to remember. Okay. And the Bhutan availed a swap of 15 billion rupees. So here swap arrangement is not only, recently the swap arrangement, it has been said that swap arrangement is not only for the foreign currency but also for rupees. That means let's say Bhutan requires the Indian rupees. So Bhutan can provide its local currency to India, and India will provide rupees to Bhutan. Okay. After the time period ends, the India will return the local currency of Bhutan, and Bhutan will have to return the rupees with some interest. So Bhutan actually took the swap of rupees 15 billion on August 5, 2024, which was rolled over on February 5, 2025 for 3 months. For 3 months. So maturity would have, like if the transaction has started today and the India has given rupees, India will take back the rupees after 3 months with the interest. The Maldives also availed a swap facility of USD 400 million. So Maldives has taken the dollars. Okay. So Bhutan has taken the rupees and Maldives has taken the dollars. As I have told you that the swap arrangement is available both in dollars and rupees. Okay. Now the last one is investment in bonds issued by IIFC UK. So here, see IIFC, it is the Indian Infrastructure Finance Company. Okay, the India Infrastructure Finance Company, it has a subsidiary in UK, and RBI is mandated to invest in the bonds of the India Infrastructure Finance Company that has a subsidiary in UK. Okay, so the Reserve Bank has the mandate, mandatory to invest up to USD 5 billion in the bonds issued by the India Infrastructure Finance Company UK Limited, that is the subsidiary in UK, so that this money can be used for the infrastructure projects in India. Okay. As at the end of March 2025, the amount invested in such bonds stood at USD 400 million. So this is the idea. So the mandate is of USD 5 billion. Any confusion till now? So this is it. Now try to answer this question. This is the first question. I hope you will be able to answer this question. Now before moving forward to the second question, let me show you that if you want to do the answer writing practice, for the descriptive answer writing practice, you can go through the Perspective 360-degree series, in which you get to know the art of writing the answer. In the series, you get the different topics and the questions. The homework questions are given, for which you can answer in the comment section below, for which you also get the free evaluation of your answers. Okay, and the series is conducted by Jaskaran sir on Monday, Wednesday and Friday at 5 p.m. So this is the first question, okay, and this is the second question. I hope you will be able to answer both the questions very clearly. So this is it. Thank you very much for joining the session. I hope you enjoyed the session. Now let's meet in the next session. Do tell me in the comment section below if you have any query, or if you like this session, do tell me in the comment section below, as well as do give me the right answer of the homework questions. Okay. So this was the first question. And this is the second question. Quota is given to the IMF as a membership fee. Okay. Against the quota, the IMF gives the SDRs to the countries, to the member countries. Yes, you have the, today at 6 p.m. you have the RBI revision session at 6 p.m. So the RBI notification and press releases revision session is there at 6 p.m. where we will discuss all the RBI website important articles in the MCQ form. Okay. So thank you everyone. Thank you for joining. See you in the next session now at 6 p.m. today.